The number one question I get every single day is this. If XRP ETFs have been absorbing institutional money at the fastest pace in regulated digital asset history, why has the price spent 6 months grinding sideways while BlackRock, Fidelity, and the entire institutional apparatus position themselves around this asset? What I'm about to tell you is not being explained on CNBC. It is not being explained on Bloomberg. It is barely being whispered on the crypto desks of the major financial publications. Because the answer requires you to understand a market structure mechanism that operates entirely outside the public price chart you stare at every morning. Something shifted in the XRP supply structure on May 14th, and the world missed the signal. The OTC desks are running dry. The settlement delays have begun.
And Jake Claver's November warning, the one almost nobody understood at the time, is now being confirmed in slow motion by every piece of on-chain data we can measure. Let me pull back the curtain. Welcome back. I am the calm analyst. Today, we decode the supply shock mechanism that Jake Claver outlined in November of 2025, and that the market structure data is now validating in real time. No hype, no Moonboy fantasies, just the math, the mechanics, and the institutional behavior that explains why the next phase of XRP's price discovery is not a prediction. It is an arithmetic consequence. Before we go under the surface, this is not financial advice. This is educational analysis of publicly available data and publicly stated expert commentary. Always do your own research. Let's start with the hard truth. 90% of XRP holders are staring at the wrong chart. They are watching Coinbase. They are watching Binance. They are watching the public order books where retail traders execute their buys and sells. And they are wondering why 6 months of historic ETF inflows have produced a price that, until last week, was still trading below where it sat at the start of the year. If you're wondering why the price has not moved proportionally to the institutional adoption, you need to understand the OTC desk and dark pool mechanism. Because this is the system that makes the apparent disconnect completely logical. An OTC desk is a private trading venue where large institutional transactions are executed away from public exchange order books. When BlackRock wants to buy 50 million XRP for an ETF creation, they do not go to Coinbase and slam the bid. They call their OTC desk, they negotiate a price, the transaction settles off exchange. It does not appear in the public order flow. It does not affect the bid-ask spread that you see on your screen. It is invisible to anyone watching the public price. A dark pool is the same concept, scaled up, historically rooted in equity markets but increasingly central to digital asset institutional flow. Dark pools exist because large buyers know one thing with absolute certainty. If the market sees them buying aggressively, the price moves against them before they finish accumulating. You see, retail investors watch candles. They watch volume. They watch the public tape. But financial institutions, they operate in the shadows. They source supply through private channels precisely so the public price does not reveal their accumulation until it is complete. This is why XRP's price has not rallied proportionally to the ETF inflow data that SoSo Value documents every single day. The buying was happening in private. The exchanges did not see it. Your chart did not see it. The institutions were vacuuming up tokens through a supply channel that you were never told existed. Jake Claver said it on the Good Evening Crypto podcast in November of 2025. XRP ETFs are eating through OTC desks and dark pools like a vacuum. Now the vacuum is almost empty. Let's do the math that the retail crowd ignores. Claver estimated the total XRP supply available through OTC and dark pool channels at between 1 billion and 2 billion tokens. That is not a precise measurement. OTC inventory is not publicly disclosed. It is an informed estimate from someone who operates in the institutional structure and has visibility into the conversations retail will never hear. In the first week of XRP ETF trading alone, approximately 800 million XRP were absorbed from those private channels. 7 trading days. between 40 and 80% of the total estimated private supply consumed in a single week. Now think about that math. Fixed cap of 100 billion. Circulating supply approximately 55 to 57 billion. Private supply available to fill institutional ETF demand, estimated at 1 to 2 billion. Week 1 absorption, 800 million. The remaining inventory after week 1 sat somewhere between 200 million and 1.2 billion tokens, depending on which end of Claver's range was accurate. That was 6 months ago. Look at what happened next. XRP ETFs have accumulated $387 billion in assets under management as of May 2026, according to SoSo Value. ETF assets crossed $1 billion in cumulative net inflows by December 16th of 2025, the fastest institutional adoption curve for any digital asset in regulated ETF history, per Ripple's own analysis. ETF assets have not recorded a single outflow day since April 9th of 2026. Now look at the consequence on exchange balances. Exchange-held XRP has fallen from approximately $4 billion at the start of 2025 to $2.6 billion today, a decline of 1.4 billion tokens. Combined with the 1.35 billion now sitting in ETF custody, the total XRP removed from immediately accessible market supply in 14 months is approximately 2.75 billion tokens, roughly 4.5% of circulating supply, vacuumed into long-term custody. Here's the math that locks the thesis. When ETF custody exceeds exchange balances, the supply structure enters the condition Claver identified as the supply shock trigger. ETF custody is at 1.35 billion. Exchange balances are at 2.6 billion. The gap is closing. At current absorption trends, the crossover is not a theoretical future event. It is a measurable trajectory with a datable endpoint. This isn't a prediction. It's a requirement. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the arithmetic of a fixed supply asset being absorbed faster than the channels that quietly fed institutional buyers can replenish. Let me walk you through the event that Claver pointed to as the preview of what happens when institutional demand hits thin exchange liquidity. Because this is not theoretical. It already happened, briefly, at a moment when the supply structure cracked. At some point during the early stages of XRP ETF trading, Kraken's official charting data registered a candle showing XRP at $91 before the price returned to normal levels. In most cases, a spike like this is dismissed as a data error, a fat finger, an algorithmic misfire. Move along, nothing to see. But here is what Claver specifically documented. Unlike similar spikes on BitTrue and Bitstamp, which were corrected and vanished from official exchange data, the Kraken $91 candle remained visible on the exchange's official charting feed. It was not removed. It was not corrected away. Claver's interpretation is that the candle was not an error. It was a real transaction, or series of transactions, in which an institutional buyer sourcing XRP through a mechanism connected to exchange liquidity rather than an OTC desk hit a market with insufficient depth to fill the order anywhere near the current price. The thin order book above current prices was swept. The price printed at $91 for a brief moment. Then liquidity returned and the price fell back. If that interpretation is correct, the $91 candle is a demonstration of exactly what Claver's supply shock mechanism describes at microscale. Thin liquidity plus institutional demand equals violent upward price movement that exceeds anyone's expectations. The $91 event happened while OTC supply was still available, while the transition from private to public sourcing was still in its early stages. Claver's framework says when the OTC and dark pool inventory is fully exhausted and all institutional sourcing moves to public exchanges, the thin liquidity condition that produced that candle becomes the permanent market structure condition, not a momentary anomaly. The new floor of how this market behaves. While retail investors are panic selling and complaining about sideways price action, the institutional signal has never been stronger. Look at what Claver documented in his most recent stream. OTC trades are taking longer to settle. Pause on that. Settlement delays are not a vibe. They are a specific, documented market structure signal. They occur when brokers are struggling to locate sufficient supply to fill orders, or when competition among large buyers is increasing the time required to source tokens at the requested price. Claver described the delays as an early sign of mounting scarcity. The OTC market is becoming strained. This is the inflection point. The vacuum has been running for 6 months. The supply that was 1 to 2 billion tokens in November has been depleted at a documented pace. And now the operators who run those private channels are telling the market, through the language of settlement timing, that they are struggling to fill orders. Ask yourself this brutal question. Does a trillion-dollar asset manager like BlackRock, Vanguard, or Fidelity wait this long to enter a regulated digital asset ETF market without absolute strategic certainty about what comes next? They do not gamble. They position. And the positioning right now, documented by analysts like Chad Steingraber and corroborated by Ripple's own institutional analysis, is that the supply compression flywheel has begun. Steingraber describes the dynamic as self-reinforcing. ETF inflows absorb OTC supply. ETF inflows push exchange balances lower. Lower exchange balances make each subsequent unit of institutional demand more price impactful than the previous unit. Higher impact per unit attracts attention. Attention brings more demand. More demand absorbs more supply. The flywheel accelerates as the supply compresses. This isn't retail FOMO. This is calculated positioning by custodians, authorized participants, and market makers who understand exactly what happens to a fixed supply asset when the private sourcing channel breaks and demand pivots to a public order book that does not have the depth to absorb it. The Clarity Act passed the Senate Banking Committee with a 15-9 bipartisan vote on May 14th. XRP broke $1.50 on the news. And this is where the supply mechanism and the regulatory mechanism collide into the specific convergence Claver described as the perfect storm. The committee passage is not a small event. It is the procedural unlock that allows the mandate amendment process to begin for the 65% of surveyed institutional investors who have been waiting for U.S. legislative clarity before deploying capital into digital assets. That mandate amendment process does not produce instant buying. It produces a queue of institutional demand that arrives in waves over the following weeks and months. That new demand is arriving into a market where the OTC settlement delays already indicate the private supply channels are under strain, where exchange balances have already declined by 1.4 billion tokens, where ETF custody is climbing toward the crossover point with exchange-held supply. Claver's framework in November described the regulatory catalyst as the event that brings new institutional demand into the market, at exactly the same time the OTC supply is running low. His words, "Everybody needs it all at the exact same time and there is not enough to go around." That is where you see a huge move up in price that people are not ready for. The committee passage on May 14th is the "everybody needs it at the same time" trigger. The OTC settlement delays are the not enough to go around signal, and the supply math is the arithmetic that connects the two into an inevitable consequence. The Senate floor vote is the next gate. The Q1 13F filings dropping in the coming weeks are the institutional confirmation event. When the Senate Agriculture Reconciliation Tax Framework is released, the legislative ambiguity that has held back the largest mandate amendments collapses, and the institutions that have been waiting for the final green light begin sourcing supply that no longer exists in the channel they were quietly using for the last 6 months. When the final switch is flipped, the wait-and-see money becomes all-in money. We are moving from an era of abundance to an era of scarcity, not gradually, not in some distant future. Right now, as you watch this video, think about what happens mechanically when the OTC channel breaks. The authorized participants who create ETF shares need to source XRP to back the creations. For 6 months, they have called private brokers and received fills without disturbing the public price. When the brokers cannot deliver, the APs have one option: public exchanges, where the order book sits at depth levels calibrated for retail flow, not institutional creation volumes. Every 100 million tokens an ETF needs to create new shares hits a public order book that does not have the depth to absorb institutional demand at that scale without significant price adjustment. The Kraken $91 candle showed you what a single transaction can do in thin liquidity. Now imagine that condition becoming the structural reality of the market, not a momentary anomaly. Once a token enters a multi-sig institutional vault or an ETF custody arrangement, it does not come back to market for a 10% profit. It is gone. The supply that has been removed from exchange balances over the last 14 months is not waiting in some warehouse to flood back when prices rise. It is held by entities with multi-year mandates, regulatory custody requirements, and zero incentive to liquidate. The institutions have spent years trying to shake you out so they can take your position. Every red candle, every FUD headline, every period of grinding sideways price action has served one function in the market structure: to transfer supply from impatient retail hands into patient institutional vaults at the lowest possible price. That transfer is now in its final phase. The exit liquidity of the confused is funding the entry of the informed. When the OTC channel breaks fully and the transition to exchange sourcing becomes the permanent condition, the retail market will be looking at a price chart that no longer behaves the way they expect. You will not be able to accumulate slowly anymore. The window for casual entry at current levels is the window that is closing right now, as the settlement delays mount and the supply math grinds toward the crossover. I know it has been hard to watch. 6 months of ETF inflows, 6 months of regulatory progress, 6 months of Ripple infrastructure announcements, and, until last week, 6 months of price action that looked like nothing was happening. But as an analyst, I am trained to distinguish between noise and signal. The price chart was the noise. The supply structure was the signal. While the masses were focused on candles and complaining about sideways action, the smart money was absorbing supply through channels you were never told existed. They were not waiting for the price to confirm the thesis. They were positioning so that when the thesis confirms, they own the supply and the rest of the market is competing for what remains. Being early feels exactly like being wrong, right up until the moment reality catches up. And reality just caught up on May 14th with a bipartisan committee vote, a clean break above $1.50, and a market structure where the supply that fed the last 6 months of quiet institutional accumulation is now telling its brokers it cannot fill orders on time. The question isn't whether the price will recover. The question is who will still be holding when the OTC channel breaks fully, and the price discovery process moves to a public order book that has been depleted for a year. Price is a distraction. Structure is the reality. Jake Claver said it in November. OTC desks and dark pools being eaten like a vacuum. 800 million tokens in week 1. Settlement delays is the early signal of mounting scarcity. Everybody needs it at the same time, and there is not enough to go around. The Clarity Act committee passage on May 14th is the everybody needs it at the same time trigger. The OTC settlement delays Claver documented this month are the not enough to go around confirmation. Exchange balances declining from $4 billion to $2.6 billion, while ETF custody climbs toward $1.4 billion, is the supply math that turns Claver's November warning into an arithmetic consequence. The supply is not gone yet, but it is going. And the rate of departure just accelerated. History does not reward comfort. It rewards those who pay attention when the room is quiet. Drop your XRP target for the day ETF holdings cross-exchange balances in the comments. I want to see who actually understands the supply shock mechanism. Subscribe and hit the bell, because when the Q1 13F filings drop and when the Senate floor vote is scheduled, my breakdown drops within hours. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient. Stay rational. The math doesn't lie and the supply structure is almost broken. I am the calm analyst. See you on the other side.